Artur Kusior says, hello, Nick. Greetings from Poland. Thank you for the opportunity to participate in the Zoom meetings. I would like to take this opportunity to ask if it's possible to post information on MFX about the possibility of opening a position on another pair. Was the case recently in the case of open positions on Euro GBP and the possibility of playing on USD MXN if you do not have the margin available yourself? I will only post things in the MFX Nick's Trades group Discord if it is a trade I actually take. As the name implies, it's Nick's Trades. I'm not going to be taking trades that I wouldn't take or that I'm not taking. I think that's intellectually dishonest. I just don't want to do that. However, I'll generally post in the Telegram, as I have over the past 6 years, for analysis for potential future trades. I just won't be exact about the entries in the Telegram channel because I have to save something for paid members so that I can have myself a business. Let me know if that answers your question. And if it doesn't, just ask whatever else you need to clarify it. And let us go see. I'll show you guys this. Oh, then it's okay. Yes, thank you. All right, cool. Glad to help, Arthur. If y'all have any questions, just unmute yourself, talk on the microphone, or you can click the Zoom option to raise your hand, or you could post in the Zoom chat. Or you could, you could come to my house and ask me here in person, like, really whatever it takes. Got to serve the clients. I'm going to set my alert here for AUD JPY. This is a far cry. I don't know if this will
Hey,
actually.
Nick.
Yeah, go ahead. Yeah.
Hey, mate, I'm Andrei. Yeah, so basically, quick question. I'm new here. This is, I think, my first call. And from what I gathered so far, basically, your edge is trading the correction after the impulse, right?
I
From
wouldn't
what I see.
I wouldn't say that's my edge. I would say that's my general approach in general.
Mm-hmm. Okay, I see. So basically, I have two quick questions. Firstly, do you only trade Forex or do you, I don't know, also trade indices, commodities, things like that?
Only Forex.
So, okay, only Forex. And do you use any sort of, I don't know, fundamental analysis? Risk on, risk off, I don't know, market sentiment, things like that.
Yeah, so actually the only fundamental analysis I use is in Japan. They have what's called the Kobe Beef Index. And what they'll do is they'll figure out like the Wagyu cattle that come in and the pricing structure of those against the interest rate of the Japanese bank. And then I'll use the price of Wagyu steaks to help determine whether or not I'm going to long or short the Japanese yen. But aside from that, zero fucking fundamental analysis. The chart goes up and down. The candles go
I
up
see.
and down. All this fundamental analysis, it's all just if you have experience and you've seen that shit over and over again, you can build a strategy around it. Yes, 100%. However, me personally, I find it like objectively a waste of time. That's just what works for me.
Mm-hmm.
And at best, you're just wasting extra time because when you use fundamental analysis and indicators and all this other bullshit, you go all the way down the long road of mental gymnastics. You get to the end and you're like, you still have to decide, am I going to buy? Am I going to sell? And if so, how am I controlling risk? What I do is I just cut all that bullshit out. I leave out the story. I leave out the narrative. I leave out the mental gymnastics and all this bullshit. And I just get to the straight end where I'm like, I look at the chart. I'm like, do I think it's gone too far? If so, I short it or I buy it and I just have a risk structure. All that really matters at the end of the day is getting to that decision of if you think it's going to go up or down and then participating in that trading opportunity with a controlled, defined risk that fits your risk tolerance. Everything else is just miles of extra work, and it means you're generally doing things that do not matter at the cost of the things that do matter. You can come to that decision about whether or not to buy or sell, as you heard me talk with Lauren about, by simply just looking at the chart. And then if you have experience, within a few seconds, your brain will either generate one of three answers. One, there's no trading opportunity, so you do nothing. Cool. Second, you buy. Third, you sell. If you do want to buy or sell, then you just move to the second portion, which is like, all right, how am I going to structure the risk? Is it going to be DCA? Is it going to be like a pseudo martingale approach where you're adding with a multiplier? Are you just simply going to use the stop loss and risk a set amount? And then once you have the trading idea and you have the risk structured, then you just enter the trade. Everybody else looking at the fundamentals and technicals and their Keltner channel indicator that can fuck off. For me, like that's just a bunch of extra work for no reason. So that's my approach.
Awesome. Thanks.
Yeah. Anything else, man? Cool. Pretty good question. Good questions. I'm really excited for a lot of like you guys who just joined Close Friends. It's cool. It's cool to I was gonna like kill the Close Friends product by the end of this year, just because like it just takes a lot of time and stuff. But I found like if instead of just letting anyone buy it, I found that if I like kind of sort of it's like a little interview process type thing first, it's more fun for me because then it means like the only people that come into close friends are people that like I want to interact with and people who I actually think are likely to start getting progress in trading. Like when I ask someone like, hey, what's this, what's this, what's this, and I ask some questions, someone may give me like a short 3 sentence response with like bad grammar and like they give zero shits about taking the time to do it. Then I might get a nicely formatted essay from some other people that are like, Nick, thank you for taking the time to read this, blah blah blah. Da, da, da. I want more of those people in the close friends chat. So I found that like interviewing people before that, like I did yesterday, I spent like 3 hours yesterday going through everyone's messages. It means that only a handful of people got into the chat. I think I approved like 23 people. 15 of them have joined so far since yesterday. And it means that the only people coming into close friends are people that I think are really going to contribute to the community and engage and ask questions. And so far, all three of you guys this morning who have asked questions so far are new members to the chat. So it's working. We're going to start with Dude raised his hand. Go ahead.
So hello everyone, hope you can hear me. um, Sorry if my English isn't perfect, but I come from Italy. My question is, I was looking at the S&P 500, and I was looking to add, but like a big amount. I usually put like 200 euros every month, like most people do, but I put like 50,000 euros back in 2018, and I was looking to add a big amount. I'm not sure if it's the right moment or it might drop even more. And yeah, that's my question. What do you think about it?
Okay, so my question first starts, it has nothing to do with your trade. It starts, are you buying into the S&P 500 as like a long-term investment or are you trying to fucking trade it?
No, I'm buying for an investment. I also trade, but that's another thing.
Okay, sweet. So the best approach for profiting from the S&P long term is just to continue buying it in regular increments over time. People who just continue to DCA every month or every 2 weeks or every 2 months, whatever the fuck the interval is for you, it doesn't matter what the price is. If you're holding it long term, statistically for fucking decades, the S&P 500 has gone higher every 5 to 10 year period. Like, so it's like when you're looking like 10, 20, 30, 40, 50 years into the future, it's history suggests it's probably going to be higher than it is right now. Not fucking financial advice, but I'm just saying, if you're doing it long term, it doesn't matter what the price is. It could have just dropped 20% the past month. It could be up 20% the past month. Consistently just DCAing in incremental amounts over a long standardized period of time. That is what has worked very well for the S&P 500 because it always returns growth given like the period of like 5 to 10 years in most cases. So for you, yeah, buy in, man. Just continue aping into the S&P. Long-term statistics suggest you'll probably be fine.
I see. So you would net like a big amount of money right now? You think it might drop? I know you don't have a crystal ball, so you cannot obviously tell me what to do. But what they talk about recession, you know, I was wondering, do you think it might go down even more? Because it would be frustrating to buy like I don't know, at like another 50,000 and see it drop like 10% by the end of the year. It would be like a dramatic, you know.
Yeah. Here's all the data we have on the S&P 500. This is on a logarithmic chart, so it's adjusted for percentages. The regular chart will look fucking insane. It actually looks even scarier. But adjusted for percentages on the logarithmic chart, this is the data going back 100 years that we have in the S&P 500. Every time you were to look at the chart over the past, like, 80 to 100 years, it's generally always been, you're always buying on higher highs. And imagine if you were like over here in 1975 and you were waiting on the pullback because you're like, nah, man, it's at all-time highs, bro. And so this is all you're looking at. You're like, dude, no, there's going to be a big correction, and Nick even trades overextended markets, bro. So like, it's going to drop, man. And when it drops, I'm going to buy a lot. It's going to be amazing, blah, 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 all this bullshit. Then it goes higher. Then you're like, okay, now it's too high to buy. So I'm just not going to buy. So now I'm going to wait on a drop up here. And then so you wait for the drop up here, but then it just fucking keeps going higher. And now this is like 50 years later, we're in 2024. And then there are still, the logic would be, it would be such that you're still saying, it's too high, man. It's going to drop, bro. It's going to drop, man. It's too high. Da, 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 all this bullshit. This is the pandemic drop right here during 2020. This was when the market broke a bunch of records. There was circuit breakers, trading was halted. All that mayhem happened right here. It is a little fucking tiny dip in the grand scheme of things. This is why no matter where the fuck the S&P 500 is, it has never, statistically, long-term speaking, been a bad idea to just continue to DCA over time. You get fucked when you start trying to time it by saying, nah, man, it's too high, so I'm gonna wait for a pullback. So instead of 50K, I'm gonna add 38K, and then I'm gonna add 18K later, and then I'm gonna do 69K after this. You get fucked whenever you do that. The best decision is just to continue buying, like DCAing in over time, because long term, provided the S&P continues to do what it's done for the past 100 years, you'll be fine. So that's why, yeah, I don't think you trying to time it right now, waiting for the pullback. This is why I asked you at the very beginning, are you investing or are you trading? If you're trading, it's hard to trade the S&P 500 long term like that, because unless you're doing anything except buying, it's kind of a sketchy bet to short, because the S&P continues to make all-time highs. And you're like, look, man, it's at all-time highs. It's like, yeah, it has been for the past 100 years. You're still going to short? I don't know. It seems kind of retarded. So my non-financial advice, generalized suggestion to anybody, this is also mirrored by what a lot of financial advisors would say, is that it's generally speaking not a bad idea to just DCA in over time to the S&P 500 given the past 100 years of the performance.
I see. Thank you.
Yeah, good question, man. We took 10 minutes just so I can tell you, like, it's not a bad idea to buy the S&P.
Yeah.
Okay, nice.
Hey Nick, this is Ben here.
Yeah.
I also just joined the close friends group,
Mhm.
and I was wondering, and I'm relatively new here, I'm new here. Are there any pairs, any Forex pairs that you prefer? Because some traders say you should be trading only one or two pairs, the ones you know inside out. You keep talking about your instinct, your gut feel. So are there certain pairs where you feel they get a better idea where they're going than other ones?
The answer is yes, but not in the way that it might seem. The answer is yes in the sense that there are no specific pairs where I feel like I can trade those pairs better than others, which is essentially what you're asking. The answer in that case is no, but that doesn't do proper justice and capture all the subtleties. So the way I look at it is there are certain pairs that sometimes present better trading opportunities than others. And it might be the case that, for example, right now, Euro GBP, I think that pair at this moment happens to present the best type of trading opportunities because it's gone really far in one direction. It's stalled, it's slowed down, it couldn't break the highs, and I just think it's going to fall now. Now, given the context of other pairs, for example, like USD MXN over the course of the past 2 weeks, I didn't trade that. I didn't even know that was a setup. And even if I did, I wouldn't have had the margin to trade it because I'm a fucking pussy and I have little margin. So USD MXN at that moment in time 2 weeks ago would have been a great trading opportunity given the circumstances. But I do not approach any pair, like for instance, like I don't have a pact with myself where I'm saying, I'm really good at trading Euro USD and I'm really bad at trading like CAD CHF. Like I used to say shit like that, but what really matters is the market environment and the context, which is why I leave all my assumptions at the door. Literally by the front door, I have a basket full of all my assumptions. I just leave it fucking there. And when I come to trade in my blue screen, green screen background here, when I come to trade, I just leave all that aside and I look at whatever the chart is actually doing. If the chart looks like a good setup based on its own merit and I can control risk and the context is appropriate, any pair that presents the best trading opportunity is my favorite pair at that moment. But I do not have specific currency pairs that I sort of feel I can like trade better than the other ones.
Okay, clear. Thanks.
Yeah, great. Anything else, man?
Not for now.
Sweet, man. Well, welcome to Close Friends. Happy you were able to get in. That's good.
Thanks.
We need more fellow bald men with black rim glasses and Close Friends.
Yeah, I need to grow a beard, of course. But, yeah, it wouldn't be black though.
It's a little bit hard to maintain, but yeah, it's beards are kind of cool. I've never had one before. All right. David, go ahead.
Oh,
Hey man, do you have a trade you've taken in recent time where you wish you would have played it differently with the data, not just looking back, but like with data in real time that you would be willing to show us like, hey, you know, I really should have done this, but I did this instead?
Yeah, every single trade that's lost that I've called in MFX Nix trades for the past 2 months.
Yeah, but like, was there data in real time that told you you should have done something else, or was that just in hindsight?
In real time, the only problem I've had, so the short answer is no. In general, no. Like 95% of the trades I've taken, the decisions I made were fine from a context perspective. There's like every now and then, right? There's like 1 out of every 10 trades or 1 out of every 20 trades where I look back and I'm like, yeah, honestly, I should have fucking managed that differently. Like, I don't know what I was thinking, what was happening, but this is just me being a human, right? The same shit will happen to all of y'all, even if you're profitable.
Mhm.
You're gonna look
For
back
sure.
on some trades and think like, yeah, that was fucking retarded. Why the fuck did I do that? And then you just try to like not fuck it up next time. But in general, no, all my trading decisions based on the context were fine. The shit that I've run into over the past 2 months is trading with a broker that has all these restrictions and low leverage. And I'm not saying it's forex.com, but it's just a broker that's regulated here in the US out of the only 3 brokers that you trade with that are the most popular, that I've just really fucking struggled to manage things in the way I normally would. I've been forced to do stupid shit like closing trades at a loss because I didn't have the margin to hold it to fruition because I sized too heavily. And it wasn't even that I didn't have enough money in the account. It's just that the margin would not allow it to go into any more drawdown. So I end up cutting trades like a third of the way to the stop. It ends up being a loss. It ends up dropping right after. I was not able to get an entry because now it's way down here and I'd get a shittier price. And shit like that happened over and over and over again. So I take responsibility for it, but it's a lot of the shit. It sounds kind of a easy cop out, right? It's kind of like a no lose situation for me. I can say, oh, I didn't have leverage. The broker shit was fucked up. I just blame it on that shit. That's legit what happened though. Like people, those of you who are Nick's trades and you scroll back through it, you will see every time I had to make a stupid fucking decision to close it early, I had no other option because had I held it and it continued going against me, I would have just been margin called on it, take the loss and not have been able to profit whenever it actually turned around. And even if I would have got back in, it wouldn't have been able to have been the same position sizing. So even if I would have won, it would have been a smaller amount, like on fucking Euro AUD. I lost $70,000 on it just to come back and make, I think like 7K or 10K whenever it finally worked out. Had I had the available margin to allocate to that trade and leverage and like proper balance and equity relative to what the margin and leverage of the account was, I would have profited from like, I don't know if I could say 90, but let me say like 80% of outcomes I would have profited from. 20% of them would have either been losses, stop outs, small losses, or break evens, but I would have profited from like 80% of the setups I've called over the past 2 months because almost all of them have looked back. If you go and play the hindsight game and say, oh, look, they would have worked out. But as far as from the constraints that I was operating within, there's not much I'd change over the past 2 months. The only thing is I have to take accountability for the fact that something does have to change in terms of me using this broker. I really don't have many other options. I'm constrained here in the US. So the 2 options are deposit a fuck ton more. And the other one is to just simply trade smaller sizing, which is what I'm doing now. The third option is like a hybrid of those 2 things. So that hope that answers your question with full context and stuff. And you can ask me to clarify anything else if you like.
No, no, all good. I wasn't asking you that to catch you doing something wrong. I think it's great to learn like from things you've done well, but I also think it's just as much value, if not more, in learning things from people that from their mistakes too.
Yeah, I'm sure if we look back, I could find something like where I can look back and honestly say like, yeah, that was a stupid decision. I should have done this. But that just doesn't happen to me very often. I've been doing this shit like 8 years, like over 8 years. So I got past, I'd say like 2019 and 2020 were the years I kind of got past making like stupid decisions like that. I'm not perfect. I'm not a saint by any means. Like I have great win streaks and I have bad losing streaks. Like it's all fucking up and down. It's like a roller coaster ride. But in general, I don't often find myself in the position where I manage a trade, I get to the end and it concludes, and then I look back and say, "Ah, why did I do that, man? It's because I was revenge trading. Like I shouldn't have done that, this and that. That just generally doesn't happen to me. However, from time to time, I'll make a mistake and I'll look back and say, yeah, I should have done that. So that's the answer.
Got it. Yeah, I mean, I'm discovering as I'm going through that like I used to like focus so hard on the entry, and I think that's why I was like not able to like consistently make money, which I still haven't yet, but I'm discovering more and more that I think it's like the management of the trade and less like on the entry of it.
Um, do you find yourself doing the thing that I described, like where you look back at a trade and think you should have done something else?
Uh, yes. But that's because like I'm like intentionally doing it. Like I'm like trying to like journal it and see like, okay, like what could I have done better? Like I'm purposely looking for things I could have improved on.
Oh yeah, well, you're just in the experimentation phase. You're just collecting data, trying to see what works. Yeah.
Correct. Yeah. Yeah. Exactly.
Okay, well, yeah. For now, it doesn't matter. None of this applies to you. This will apply to you like after you have it depends on the time varies, but maybe like 6 to 12 months is a good starting point for just accumulating enough experience to then be able to say, like, then you can say with a little bit of conviction, like, yeah, like doing this is generally a better idea than doing that. And then over time, you'll have the data and the experience to help dictate what your decision should be. You should be like, it's better to make this decision, so I'm going to do more of this because this is what seems to work, and I'm going to do less of this shit, which seems that doesn't work. Then you kind of carve it out over time, where eventually you start, like, it starts to become more and more aligned whenever your actions that you took in the past are confluent with what you think the best decision should have been after you're looking back at it in retrospect with like a clear lens because you're out of the trade and there's no emotions. Once those two things start to align a lot more, then you'll notice you're like, it's almost a hit every time. Like it's over and over, like you get it right, you do it. But every now and then you stumble upon a trade where you're like, why did I do that? That was weird. I closed the trade on Friday because I was scared of holding it over the weekend. But then I've never been scared of that before, and it's usually fine. And then the weekend ends, and then Monday or Tuesday, it then goes and hits the original target, but you weren't able to re-enter. You might look at some shit like that and think like, oh, yeah, that was kind of stupid for me to close on Friday because there was no good reason to do it. I guess I was just scared that the open profit would be eaten up through the gaps or spread, or it might reverse, or for some random irrational reason that made no sense based on your data or experience. Then when you look back at that, you just kind of document it or just keep a mental note of it. Then you can continue to get better over time. But experience just kind of hones your skill set.
Totally. So when you say like data, like what data tells you, is this just all like data you're taking mentally, or is it something like you're looking at like my FX book and you're using that data in order to make your decisions and learn from?
My FX book and portfolio trackers and looking at win rate and risk reward and all this shit. This sounds very contrarian. I don't think it gives that much of a beneficial edge for people trying to get experience to learn to trade profitably. And here's why. You can look at the data and you can see, yeah, Euro AUD, for example, is my worst pair over the course of the past, years of data or months of data. But then you can look at like, okay, I generally win more longs than I lose on my shorts, maybe like, so you might learn little metrics like this. But what matters is your actual decision making and what happens. Looking at black and white data does not ever fully capture all of the texture and the granularity and detail for what your actual trading decisions are. Your trading decisions and looking back on what your decisions were with like a sentence or two of an explanation about why you took a trade and then what happened. That's when you start being able to put together like, here's what my actions were in the moment, and then here's what the outcomes were. The outcome is you're either profitable or you're not. All of these little metrics like win rate, average risk reward, win per trade, expectancy rate, and Z score, like there's all these fucking metrics. Those are just all proxies to help see what the end result is, which is whether or not it's profitability. You'll notice some of the best, maybe you won't notice, but what I've noticed, well, personally, and this is true for myself as well, some of the best traders I've ever seen, they don't worry about all that shit. The only people who are really concerned with that shit is people trying to program automated EAs, which doesn't even fucking work 99% of the time. And I know because I've been in this industry 8.5 years. People who are profitable generally don't give a shit about that because they recognize it is just all truly subjective. It's not to completely dismiss saying like, if you have a 1% win rate and a 1-to-1 risk reward, yeah, you're not profitable, like sure. But there are so many other different dynamics that come into play. What if you started that trade off with a 1-to-1, but then you extended the target, and then you moved the stop loss in a little bit closer, or you added to it. So now you're risking double on this trade as you were in a previous trade. These are all very nuanced little decisions based on the context of the circumstances whenever you're entering a trade. This is why instead of looking at metrics like, for instance, my FX book or a portfolio tracker, or going through your P&L and just looking at that without combining what your decisions were with it, I don't think it's beneficial to actually crafting that intuition that's based on experience. What's better is to just, for example, you can journal your trades in some way. The thing I usually suggest to clients, because it's the simplest, is start a Discord server with just you in it and just post the trading view link of your trade the moment you enter. Put like a 1-sentence explanation. I sold because it made a higher high and I thought it would drop. Just something really simple so that you can, whenever you read that in the future, you can see, okay, this is why I took the trade. And then whenever the trade concludes, you can close it anywhere. You can let it hit stop, let it hit target, or you can close it early, whatever the fuck you want to do. Just write what happened. Like I closed the trade here, it went down into profit, then it started reversing right before it hit the target, and I just closed like 80% of the way to the TP. Boom. Okay, now you have your entry, now you have your exit, and you have your reasons why you did that. That way you can get back into that moment and relive what happened and then see what would have happened afterwards after you'd already exited the trade. That starts allowing you to piece together what decisions lead to more profitable outcomes. And in my very humble opinion, you don't get that from just looking at the stats and the metrics and the black and white numbers alone. You get that from looking at your decisions and how those decisions contributed to whether or not you were profitable. That is my response. What say you to that, sir?
I say thank you very much, sir.
Cool. Yeah, good question, man.
Appreciate it.
David says, Nick, are you looking into other unregulated brokers that use TradeLocker, which I think has a license with TradingView? At the moment, David, no, I'm not. I prefer to just use a broker that's regulated. For now. That could change. Elias says, hey, Nick, my mic isn't working properly, so hope it's okay to type my question. Yes, it is, Elias. Perfectly okay. Elias says, how do you navigate the feeling of wanting to push the account? Push the account. I don't know exactly what you mean by that. Like, I'm so grateful, Nick, to know that Forex exists and I have a small idea of what to do, but I'm still working every day to become consistently profitable. I've noticed I'm struggling with not being fully content with my gains. Last night, I bought on 80 CHF and made just over 7% by the time I woke up. Closed this morning and I'm happy about it. But when I look at my account, I still want to go in and make more, almost to fast forward to the point where I can quit my job and take care of my family. Do you ever experience this, or am I just being greedy? Thoughts? Did I ever experience that? Yeah, I did. There would be times where I traded the whole day and then I made like $120 and I was like, fuck yeah, right? Because that was like more than what I would make at my job for the day. So I would get excited, but then I think, what if I can make like $200 per day? That would be insanity. That's almost 3 times what I make going to work for the whole day. So yeah, it happened. Are you being greedy? I don't know, maybe. Like, it just depends on what you mean by greedy. Greedy just simply means like you want more. Like, this is not the actual definition, but it's just the colloquial definition of what most people mean when they use the word greedy. It just means you want more, but everyone fucking wants more. Why the fuck are you guys trading? You want more. You want maybe more time, more money, more allocation of energy so that you can put your energy into things that you see fulfillment and satisfaction in for your life. Everybody wants more for themselves and their family and the ones they love and their dog. But are you greedy in the sense that it's a bad thing? You should be stigmatized for it? I don't know. Like, no, I don't think so. I don't know. It's just really subjective. It depends on what you mean by greedy. Those are my thoughts. So whenever you say so anyway, what's the solution to this? The solution to this is, number one, you can just continue risking more, which I guarantee you'll eventually blow your account. If you made 7% in one day on one trade, that probably means you're taking on very high risk. It sounds like it's a small account, but like, for example, I would not deposit $5 million into an account and risk like 10% of the account. That's like $500,000. It's $500,000 on one trade to hopefully make 10% profit on the next trade, because one losing streak will murder the account. Like, had I done that with the account I started 2 months ago, I've lost like half of the current account that I have right now. I'm down like 150 grand if you add in swaps and commissions. So it's like 140 grand. I just wouldn't do that because I know like losing streaks happen and winning streaks happen. And the primary objective is just to control risk and protect the trading capital. So when you say you're being greedy, like, the first option is just risk a fuck ton, but you know what's going to happen. If you don't want to take my word for it, feel free to experiment. Continue risking shit tons on your smaller account. Guarantee you'll probably blow it at some point, and that will probably be very soon. Now, the alternative here, if we leave that in a basket by the front door and throw it down the trash chute, the alternative is just to lower your expectations. Just lower the goalpost. Just say, like, I'm not going to be able to make a full-time income from trading for like the next 5 years. That now, is that true? I don't know, but it doesn't matter. What matters is that you lower your expectations. So that way you get used to making like $50 on a trade and then being happy about it. The only reason you're unhappy is because reality does not meet your expectations. You have the expectation, or at least a strong desire, which functions as an expectation for your situation. You have the strong desire to make a full-time income and then support your family and do all this cool shit and quit your job and all this shit. I get it, bro. We all want that. But the thing is that's probably not going to be the reality for you at any point in the near future. So you're better served by just saying, you know what? I'm probably not going to make a full-time income trading even within the next year. Now, is that true? Maybe not. Maybe you will, but who knows, right? But it's better to just lower the expectations to zero, because then what you start focusing on, instead of the dollar amount you're making, whether or not you're trading full-time and you're supporting your family and doing all the shit that you have idealized in your mind, instead, you're just focusing on the actual process, and you're focusing on, I made $50 today. That's great. How can I keep this money and not fucking lose it and control risk and then get through the losing streaks, not too injured, and then it'll allow my winning streaks to take my watermark of the equity of my account higher. Then you'll have a losing streak or a setback that pulls back a little bit. Then you'll have some more profits that go up, and then you look back and maybe you grew the account 100% within like a couple months, right? Now, on a larger amount of capital, you probably won't be able to do that. But on a small amount of capital, if it's like $100 or $1,000, yeah, I mean, if you double the account, you make $100 on a $100 account, or you make $1,000 on a $1,000 account. It's not that much money relative, right? But percentage wise, it is. But the whole key here is just to keep on getting better and better. So that way, like right now, let's say you average $100 a month profit. Let's say a year from now, you start averaging $1,000 a month profit. Let's say 2 years from now, you're averaging like $3,000 a month profit. You get to the end of the year, you've made 36,000. It's about 3K a month. And then let's say 3 years from today, you're averaging like $10,000 a month profit. You're not going to give a shit that 3 years ago, which is today, you were averaging only about $100 a month profit. What you're really going to care about more is whether or not the experience you collected on the way continued to scale along with your trading capital and your risk tolerance. If those things are all true and you're doing good, then you're going to get to the point someday where you look back and you laugh and think, wow, I used to get so excited about $100 a day. And that was cool. And that was good because you knew you were making progress. If you don't do this process that I'm telling you, the only alternative is you just risk a fuck ton of money and you're guaranteed to blow your account. I will bet money that you would blow your account if you continue to risk large amounts, and then you get nowhere. Better to be somewhere in 3, 4, 5 years from now and look back and having loved the process and made the experience to justify you trading profitably than just being a fucking ape and degenerate and doing what like 90% of people are doing, which is that over leveraging and just risking a fuck ton per trade, trying to get rich quick. It literally never works. Like find one situation where it works outside of someone winning the lottery. And even if people win the lottery, most of them lose all the money very quickly because they don't know how to manage it. Even if you grow your account really quickly and you're able to make a full-time income for just this month, you're very likely to lose that money at any given moment over the next 2, 3, 4, 5 months. So I would say take the slow and steady route. Be happy about making $10, $50, $100 a month, and then let your experience scale with your capital. And then everything works out in the end. Ideally, not financial advice. Let me know if you have any other questions or if you want me to add anything to that, Elias. You said, I agree entirely with what you're saying. You're an absolute stud. You've given me the perspective I needed. Thank you, Nick. You're welcome, man. It's all about your mindset. Lower those expectations and be happy with little. Then whenever you're making a lot, you will be rewarded. Dude, you're up next. Go for it.
So I have another question. I was wondering why you never move your stop loss or break even after a certain amount of pips of profit. Like I understand that it might go back and retest like multiple times, like a Euro GBP. We see it tested 3 times the top, and now it's finally going down. Like I had 2 positions. I closed one in profit just to be sure, and my other one, which is really high, like way higher, my entry was higher than yours. I put my stop loss at break even because if it actually reaches that point, it might just go up again. And it's not a bad thing because I've already made some profit and I might get an even better entry later. So yeah, that's my question.
Yeah, so the main question, if I were just to distill this and isolate the question, is why don't you use break-even stops, Nick? That's pretty much what you're asking.
What do you mean? Sorry.
What I did is I just tried to distill your question down to something very simple. So you're essentially asking, Nick, why don't you use break-even stops? Is this correct?
Yeah, exactly. After a certain amount of profit is already made, like 20 pips, 30 pips, like just to be sure, because if it goes back up to 30 pips, not only you're not earning anything, but you might risk having a position that might go into loss and close it at a loss for no reason, when you might just wait a bit, close that one to a break even and re-enter higher, like get a better entry.
Yep. So I understand completely. I was just making sure the question was very clear for all the listeners. The reason I do not use break-even stops in general, because sometimes I do, but in general, like most of the time I don't. The reason is because it fucks with the risk structure. Now, what does that mean? It just means it lowers the probability of the outcome resulting in a profit because of something you've already described. Sometime price will come back and just retest the entry and then it goes down. And then you would have ended up getting stopped out at a loss or taking a break even on a trade that just ends up going into profit. Sometimes it will go and fucking make a higher high after you've sold, like maybe down here. It goes into profit for a little bit, then makes a new high, and then it falls back really quickly. In the context of the way that I trade, waiting for prices to quote overextend, whatever the fuck that subjectively means, when I wait for them to go really far in one direction, then I start shorting. I'm going in with the idea that, like, look, I know this shit could go up a little bit further before falling eventually, but I'm right on an outcome by outcome basis, higher than 50% of the time. And so with that being the case, it allows me to let the stats play out without fucking with the risk structure and without getting taken out based on a technicality, and instead only losing a trade if the merit behind the trading idea simply did not work and the trade invalidated. So if it fucking goes up like another like 600 pips and then I take the stop out and I lose 20, 30, 40, 50K, you know, that is what it is. And that happens every once in a while. But whenever I use break even stops, it causes the situation which you described, which I'll show right now on the chart. On Euro GBP, my entry is, we're on a monthly chart. I was so confused. I was like, what the fuck is going on? My entry is like right here. So I entered like right here at that, like literally on, what was this, Thursday? Whenever that was, August 7th, I entered right here. I ended up going and testing the previous highs right here. This was painful. I wanted to add. I told you guys in the Knicks trades group, I wish that I could have added, but I couldn't. No margin. I have such little margin. My margin is small. I have a tiny little margin. And then it ended up coming back down, going into profit, and the trades are currently sitting in profit right now at the, like, this is like maybe 2 hours ago or an hour. This was on Friday, never mind. It's sitting in roughly the same amount of profit. I think a little bit more profit than in that screenshot. So like a little over $7,000 profit. Had I used a break-even stop, or like had I even tightened the stop loss up here, or sure as fuck used like a break-even stop loss after it started going to profit, this would have taken me out. As well as this right here, due to spreads, had I moved the stop to break even here, underneath my position, which is the short arrow on top, that spike up there, just the spread bar alone might have taken me out at break even maybe. And then it just would have gone back into profit. Now, there's also going to be times where like I'm wrong and I don't move the stop to break even, and then it ends up continuing further against me. And then it ends up either being a lot of drawdown before I add, and then it comes back and then it's a net break even. I just close all the trades and move on to the next opportunity, or it'll just result in an actual like loss. So it'll either be a loss that I close manually, or it'll hit the stop loss area, or I'll DCA it and then it pulls back and then I just don't like it. So I close it a little bit less of a loss or something like that. But what I found for me personally, I'm not saying this applies to everyone. I was saying for me personally, when I use break-even stops, in general, it just fucks with the statistics. It fucks with the outcome of it resulting in profitability. And the closer your stop loss is to the current market price, the more likely that stop loss is to be triggered. If I've done my analysis correctly, meaning I've just waited for a proper entry that I think is reasonable, if I wait for those entries and then I get in and then I use a wide invalidation and stop loss, and then just a 1-to-1 TP, it means the likelihood of it hitting the invalidation on an outcome by outcome basis is lower than the likelihood of it going and then hitting the profit target. And I just mean that it's more than 50% likely to win on an outcome by outcome basis, not the individual trades that go in because there's like multiple trades and all sorts of shit. It just means that the basket probability of that falling from here to here eventually before hitting the stop or going to invalidation is higher than 50%. So that is why I don't use break-even stops, just because it messes with the statistics and it makes me less profitable than if I were to use them. Does that answer your question?
I see. It's a different way. The way I look at it, it's a bit different because maybe I'm a bit more conservative about my money. Might be that I don't know the reason exactly. I just see that like Euro AUD, I did not put a break-even stop loss on that one, and when I was sleeping, it got really far high, really far up, and yeah, I got fucked, like most people here, I imagine. So I don't know. There's no real right or wrong way to do it, but I try to move my stop loss after 30 or 20 to 30 pips in profit. I move it to break even, because if it actually goes back up there, I get like I question myself. Was I right to entry right there, or should I have waited a little bit more? And that's the reason.
What you say makes perfect sense. I've helped a client through this before because he essentially said the same thing. He's like, I'm more conservative. I want to control risk better. if you move the stop to break even, then you know it's not going to be a losing trade. It'll just be a break even or it'll be profitable. All right. And this all sounds so good in theory. Here's the way it actually works in practice, just in my personal experience. It just applies to me. It may or may not apply to you guys. In practice, I am more likely to lose money long term, or at least not make as much money long term, which I'd consider not making money as the same as like losing money. So missing a good trading opportunity I would have made 50K on is the same as losing 50K, because I would have had an extra 50K, but I didn't because I didn't take the opportunity. So missing out on profits is what it would cause me to do. And the reason is for the same reason that I just described it to you. It's like whenever you move the break even stop into place, or it's just tightened up, or it's in profit, that makes the stop loss far more likely to be hit. And it does not allow the original trading idea to come to fruition. Now, again, this is just true for me. It just fucks with my statistics. While it sounds good in theory to say, look, it's not gonna be a losing trade, it might go and stop you at a break even, and then you say, look, see, it protected me. But then what if you find out that more than 50% of those trades actually end up going to your final target? Let's say, for example, 65% of them go to your final target, 35% of them would have ended up continuing to loss. You're actually fucking yourself if those statistics are true, if you're right more than 50% of the time. Because if that's true, then just holding it and doing nothing would be the better idea. Because if you know 65% of the time it's going to hit the target, you're going to be winning roughly 2 out of every 3 trades. But when you use a break-even stop loss, little technicality is a little pullback spiking up against you that could throw you out. And then now maybe you're only winning like 20% of your trades, and then you're like either barely profitable or not profitable or break even or something like that. But it wouldn't be anything compared to what you could have made had you not done that. Again, I'm not saying this is true for you and that it's going to be the same for you. What I'm saying is it is a fallacy to say or to assert in practice that using a break-even stop loss allows you to control risk better and make more money. From my experience, that is simply a fallacy. It's something that sounds true, but it's not actually true in practice for me. In my opinion, moving a stop loss to break even increases the risk of your total profitability long term because of the fact that it makes the trades more likely to lose based on technicality and a little pullback upwards, instead of letting the outcome just play out. Like it's gone up here, you sell, you have your stop, you have your target, and then you just let it. Sometimes it's going to float around for a little bit or even go against you or start going into profit, then pull back, then either go to the final target or go to the stop loss. If you can be right more than 50% of the time, my opinion is just to let the edge play out and not fuck with the trade and lower the probability of it working out. Because whenever you start doing things like that, at worst, it's detrimental to your trading. At best, it's frustrating because you're not making the amount of money you could be making. So again, just my opinion. What do you think?
Yeah, I understand perfectly what you say. I might give it a try again. Maybe have a lower, a smaller lot size, but I'll give it a try. Thank you.
Have you ever heard the term Netflix and chill?
Yeah.
Yeah, well, this trading strategy I just told you about, I call this no break even stop loss and chill. It gets more exciting and fun.
I see. All right. Thank you, man.
Yeah. Andre.
Yeah, man. So regarding what you said about profiting long term and I don't know, letting your edge play out. Since you're a swing trader, what do you say would be your ideal, I don't know, period of time for your edge to play out? Like it would be 3 months, 4 months. Like when are you comfortably knowing that you actually have an edge in the market, and how can you know that what you're doing is actually profitable long term?
This is a very good question. And if I'm being honest, I don't have a good answer to it. My intuitions tell me to just say like about a year of data. Like if you've been doing it for a year and you're still not profitable, that might be something to look at. But even then, the reason I'm reluctant to give a straight answer to this is because me and one of my friends from the United Kingdom who created an automated trading strategy that works off of my approach that is profitable, and it just uses DCA. It doesn't use hedging. He created that and he modeled it off my strategy that I was using in like 2022 and the beginning of 2023. We modeled something that worked off of just using stop losses and not DCA. And it was very simple. It just simply said, if price has extended in one direction without a particular amount of pullback based on the impulse, we objectified all this and put it into an algo. We found that in the year 2021, it would have returned 85R. And it just traded on GBP USD, the exact same strategy, right? It was very simple. It essentially bought and sold at round numbers with a 50 pip stop loss and a 50 pip profit target. In 2021, it returned 85R. In 2023, it returned roughly break even. It was actually like negative 2R. So here's the thing. The exact same strategy, had you modeled it in 2021 and traded it in 2021 and just ran the algo, completely automated, right? It took like 2 trades a month or some shit like that. That returned 85R. That's fucking crazy. Like if you're risking 10K per trade, that's almost $1 million for the year. However, the same exact strategy, like objectively, it's a black and white, same fucking strategy, returned a break even and even a small loss. If you add commissions and swaps, it was probably, you know, more of a loss than 2R, but it roughly returned break even or losing a small loss for the year 2023. How do you explain that? Like, this is something that literally worked 100% worked in 2021, but the same strategy modeled the exact same dynamic. There's no human emotion. There's no dynamics. There's no decision making that's like dynamic trade management. It's just the same fucking thing goes to stop loss or profit target that returned a loss in 2023. And that's a whole year of data. If a trader found that strategy in 2023, they might think that it doesn't work and they might abandon it and move on. And even worse, what's even fucking scarier is that if you have a profitable trader who's manual trading and it's not automated, they might think, oh, I was doing something different in 2021 and now I've changed it. That's what's happened. And now, okay, yeah, so I've changed it. So I need to go back or I need to find out what's working because the strategy isn't working anymore. The trader will start giving themselves this story and this narrative about why it's not working. And again, this is what's fucking scary is that it's the same exact approach. 1 year works amazing. And then in a whole year of data, it doesn't work amazing. So that's why I hesitate to even say that even after a year, whether or not you can truly know whether or not something is working. This is why I just tell people, get 6 to 12 months of experience, because at least after you get 6 to 12 months of experience, you can start kind of transitioning into what you think is more likely to work and what you think is more likely to not work. What's even better about this experience is that you can judge things based on the context. An automated trading approach, you can't. The algo buys or sells whenever you tell it to based on what the conditions are. As a manual trader, if Euro AUD is spiking up like a fucking freight train like the last week or two, you can decide, oh, maybe it wouldn't be a good time to sell right now. Every candle is a bull candle on the H1 and H4 going up. Might be better to wait for things to, quote, calm down, whatever the fuck that means, before entering a trade. Might be better to wait for the, quote, momentum to slow down or for it to start looking, quote, bearish, right? All these subjective terms that kind of help you say, maybe it's not best to enter right now. Maybe it's best to wait and then enter when I feel like the context makes more sense. You can't do that in an automated trading, and both have their pros and cons, but it is because of this that it is very difficult for anyone, I think, to provide a truly intellectually honest answer as to how long is a good enough time period to determine whether or not you're profitable. If you hold a gun to my head and say, Nick, you have to answer this question, I would just say, give it maybe 2 years. Now, I know that that's not a sexy answer, but that's the only way you can be intellectually honest.
I see. And just a quick follow-up. You said 2 years. And how many trades do you have per month? I'm trying to pick your brain a bit.
Yeah, it depends. There was a month earlier this year where there was 3 weeks where I didn't take a single trade. Then there's like the month of July where I took, like, I don't know. Let's go and fucking look right now, man. Let's go to my FX book and see if we can find this shit. Can somebody, I don't use my FX book. How do I find out how many trades I took in the month of July? Monthly? Is there like a period? Can somebody help me with this? Here we go. Oh, wait. Is there a way how many trades I took? This should be 9, 8. But even then, wait, no, 13. This is not right. I'm gonna have to estimate, bro, because I'm looking at objective stats and I still can't find the answer. I would estimate, like, for July, I took maybe 3 trades per week, 3 or 4 trades per week. However, there are months where I may only take 2, 3, 4 trades a month. So it comes like out to be like 1 trade a week. At the beginning, when I went on the huge fucking win streak at the beginning of this year, when I started Nick's trades at the end of March, every single week I was only taking 1 to 2 trades. And then in a matter of like, it was like about 2 months, I had made like $180,000, like over $180,000, just taking like 1 to 2 trades per week. So how much data? I think it really depends on the month. And then what's even worse is like, how do you basket in? Like, do you basket in total trades you took? Because what if you had 3 entries in the same pair? Does that count as 1 trade or 3 trades, right? In my opinion, it's better to look on an outcome by outcome basis, which is why I always denote that when I'm saying like, I'm right about the outcome, like higher than 50% of the time. But the actual win rate for the trades, it might be the case that like the first 2 or 3 trades fuck up and the entries are a small loss, but then the last position had a huge position size. And then when it came into profit, it was a net profit, but I might have won only one of those trades in actual P&L, but the other 2 or 3 might have been a small loss. So even though the win rate is like 25% for that outcome, I still made a huge profit on it. This is another reason why I don't think objective metrics are always the best tool for determining profitability and determining what the best decisions are and solutions to do in the future. So my intellectually honest answer is number of trades to take per month depends on maybe between 1 to possibly like 20 or 30. It's like a wide variety depending on the month.
Oh, awesome. Thanks.
Yeah. See if we have any, we got some questions here in chat. All right. Andre says, how do you raise your hand? Reaction, click on it. Okay, yeah. So you found out how to raise your hand, Andre. That's good. I'm like 20 minutes late to that. David said, is the reason you don't move your stop to break even the reason you usually don't partially close along the way, or because of the risk structure, or a different reason? I don't know if it's the same reason. Like the reason I generally don't close partial positions, and again, sometimes I do. So this is all very funny because I'm saying like, this is why I don't do it, but then sometimes you will see me do it. The reason why I, in general, don't close partial positions is because it, in practice and also just armchair philosophy, it yields that it's like a lose-lose situation. And here's why. I posit that closing trades early is a lose-lose situation because if you close early, let's say you close 50, your trade's in some profit, you close 50% of it. So you're like, quote, booking some partial profits, right? And then let's just assume you don't fuck with the stop loss or take profit. What that means is that if it continues going into profit, you're going to think to yourself, it's like subconsciously, and not in a negative way, but just subconsciously, you're going to think to yourself like, fuck, I closed partial profits and then now it's gone into more profit. So I could have made, I don't know, 20K on that trade, but I only made like 13K. Okay, cool. Well, you missed out on some profits. The same is true with the inverse. You close a trade early, partial profits, right? And then the trade ends up going against you and then it goes to your original stop loss. So then you're thinking, fuck, like again, whether it's subconscious or not, like you're thinking subconsciously like, fuck, had I just closed the full position there, then none of it would have been lost. And not only would I've only had a partial profit, I would have actually had a, you know, like double whatever the profit is that I closed. And then I would have avoided the loss had I only just closed the full trade. So because of this like dichotomy of like lose-lose, I just find it's better like I get in with the position size I think I should be in, and then I get out whenever I don't think the trading idea makes sense anymore. This whole thing of like throwing a bunch of darts at the dartboard with different hands and different, I'm going to close partials here and I'm going to do this, and I'm going to move the stop loss and all this. Number one, it introduces complexity, which complexity is like the thief that steals a lot of people's profitability because they have no clue of how to replicate their decisions or keep it simple. But then the second thing is that it just doesn't seem to work in practice for me. Like I just get better results not doing that. Partially because of the armchair philosophy I've just shared with you guys. It's like a lose-lose, whether you win or lose. Like you're like, fuck, I could have won more, or fuck, I could have lost less. So there's no real way to win. And then also it introduces a lot of complexity. So for those 2 reasons, that's generally why I don't close partials early. But again, keep in mind the caveat. There's sometimes I will do this depending on like margin. Like if I'm like, I don't want this to get margin called and this is some good profit and maybe it was already in a bunch of drawdown. So I want to be in this trade, but just with a smaller position size. Then I would close partials and something like that and just, or maybe just close the full position, but then just re-enter with a smaller sizing. That's fine sometimes, depending on the situation. But usually it's just to free up margin so I can participate in another opportunity that I believe is better given the context. Let me know if,
Got it.
yeah, that was you, David.
So one thing I forgot to ask in that is that like, so say you're DCAing in, or you took multiple positions in this case, like, is it like if you close one of those, you can is that, do you put that in the same level as partially closing, or is that, since it's a technically a separate entry, you're considering a separate position and you manage it differently accordingly?
You could argue either way. Like what matters, the way you can solve all of this and not make it complicated is say, should I buy or sell right now? And if so, what is the risk? And whatever the risk is, am I comfortable with that? And if the answer is all this to like, yes, like I should buy or sell right now and the risk is okay. And if it goes to here, then I'll either add or I'll stop out and the profit target be down here. At any given moment, if those conditions are true, then yeah, it's fine to enter the trade. If they're not, like if you think, I don't think this is the best entry, I really just think it'd be way better if it just spiked up again, then I can enter. And then the stop can go further, but the same pip distance, but it can go further physically on the chart. Then the target can be closer and I can use a heavier position size. And I won't have to add to a losing trade if it does that, which isn't bad to begin with. But I'm just saying, like, if you enter down here, then it goes up here. Now you're having to add to a trade. Then if it bounces, you're just trying to maybe break even or make a smaller profit. There are plenty of cases where it's just better to fucking wait for a better entry that you personally think subjectively is better. And there's also other cases where you're like, this trade is fine, but I don't want to be in as heavy. I just, maybe instead of 20K risk, I only want to risk 10K. If that changes in the context of the trade where you're like, this still makes sense, but I'm not as convinced, still convinced enough to trade it, but maybe you no longer want to risk $100,000. You just only want to risk maybe 25,000 or something like that, right? I'm throwing around numbers that I use just so it's not like dishonest. I'm just using like, I understand for you guys, like me throwing around, yeah, David, risking 100K on a trade on a Monday, no big deal, but like whatever it is for you, $100, $1,000. If you're comfortable risking that initially, but then based on the price action and how it started to play out and develop, you're no longer comfortable risking that much, but you still want to be in the trade, then yeah, it's okay to close a small position of it. You can treat new trading opportunities as entirely different, or you can treat them as like the same trading opportunity, but just a re-entry. So if you were in like 10 lots and then it goes into profit, then you close and you're sitting out, and then it starts going sideways and there's not much of a pullback, then it starts looking like it's going to break the low and you just want to re-enter your 10 lot position, you can do that. Like, yeah, that's fine. It's all just, I guess, depending on how you look at it.
Got it. And kind of piggybacking off of that, and in combination with a few questions that are asked today and some previous experiences thinking back, I feel like it's easy as hell, as well as dangerous at the same time to make a wrong call or make a wrong emotional decision, but it work out in your favor and make it almost trick you into thinking it's like the acceptable, like the right thing to do, or it's correct. How do you know whether like that's the case, or if it's just like it was just something that was, you made the wrong decision, but it just worked out for you this one time or just a couple times?
Yeah, the simple, non-sexy answer, but the one that's the most true is just experience.
Got it.
Does that make sense, or are you like brain dead?
No, I mean, it makes sense.
Okay, cool. Yeah, it's
Essentially ask you that in like a year.
Yeah, so yeah, you could say, Nick, I found that more than 50% of the time this doesn't work. Should I keep doing it? And after I get done virtually slapping you, I'll say, no, David, you shouldn't keep doing that. The more experience you accumulate, yeah, the more you'll kind of know, like, entering a 100 lot sell on Euro USD right before NFP every month is probably a stupid, dumbass idea. But like if you couldn't deduct that like philosophically before you enter the trade, then you're gonna fucking learn in reality through experience, which is why it's good that you just use a demo account to allow yourself to go through all those fuck ups.
For sure.
Don't do that on NFP on Euro USD with 100 lots before NFP. Don't do that. That's just don't do that. Please God, don't do that.
All right, I'll make a note of that right now.
Don't ape into EU before NFP. Nick Sean financially advised me to do that. Okay, we're getting close to wrapping up the session. Before we do, I will hang out here for another minute, see if anybody else has any other questions. And if not, we will all call it a day and jump off the ship and swim to Pip Island, where we will party with bitches. Sorry, my girlfriend's on the couch. Where we will party with each other, a bunch of grown-ass men on the island together, hanging out. Go ahead. I think that's Mohammed. Is that you? I don't know how to read Arabic.
Hussein, you mean?
Hussein. Okay, we had another client who literally lives in northern Gaza right now named Mohammed.
Yeah.
So yeah, okay. Hussein, yeah, what's up, man?
Yeah, okay. My question is about your risk tolerance, or how much do you risk per trade? You said, let's say about $10,000, or for example, 20,000. let's take the example of 10,000. So you have an account of 200,000. That's 5% of the account. How do you structure that that amount of risk, which is 10,000? I mean, per lot. I saw your trades on the Telegram when you post them. You usually take like 3 or 4 or 5 trades, either in a row or in different times. So do you take like 1 or 2,000 per trade, and then that sums up to 10,000?
I want to make sure I'm actually answering what you're asking, because there's a couple things that I think you could be asking. Is there a way you could maybe clarify and make it more concise so what your specific question is?
Okay, let's say you're about to risk $10,000. Okay, and that's equivalent to 5% of your account, which is 200,000.
Mhm.
How many trade? I mean, how many lots do you intend to take? Is it, I mean, do you put, let's say, 100 pips? Your expectation or your risk is that the price can go against me 100 pips above. Let's say you're taking a sell. So you will take a sell like each 20 pips going up. Did you take that? Or
So I think, so what I'm hearing is you are asking, do you add to a position or calculate position size based on how much lot size you're using for how many pips it goes against you? Is that-
yes, yes.
Okay. I don't want to fuck this up and give you the confusing answer. So I think a better way would just be to, I'll show you what I do in a very simplified way. Does that work?
Okay.
So if I'm using a DCA risk structure, like let's say, for example, this is a DCA risk structure. This one, my original entry, this would have been stopped out. This is where I first started shorting this fucking bitch. So we're going to just close that just for the sake of simplicity. We'll use so let's say I started the position right here. Let's say the profit target was like somewhere down here, 500 pips, and the invalidation was somewhere up here. The invalidation would have got breached on this. Just for the sake of fucking simplicity, let's just say that it's like up here. So I started it here, and let's say that my invalidation was 500 pips, so just above the high. What I could have done is said like, okay, from this position here to where the invalidation is at, let's just pretend I risk $10,000, for example. What that means is that if price gets up there and it's like a 1-to-1 potential profit target and price goes all the way up here to that amount of loss, I then have the opportunity to then enter another trade up there if the risk structure is for DCA. Sometimes the risk structure is just let it hit the stop loss, then reevaluate after that, and then maybe re-enter. In some cases, though, it's just, I'll just add to the losing trade, but I'll do it in a way where it's defined. What I'll do is I'll pre-plan it just very roughly before the trade. I don't go into all the meticulous details of the millions of different outcomes, but in general, I'll just kind of say, okay, you know, if it goes up there and I want to add, that first position will be in a $10,000 drawdown. And then if I use the same entry and the same stop loss with the same position size, I didn't mean the same entry, the same position size. This next trade, that will be $10,000 if it goes up. And then this trade will have another $10,000 of risk. So what this means is that that trade is in $10,000 of drawdown. If I add the same position size and the same distance of invalidation up here, that'll be 10K plus a total of 20K risk. The risk for the total basket of trades goes up from 10K originally to now having added that one, it's now 30K. So it's an additional $20,000 of risk. Now, this does has more risk, but it's not much different than just like taking a stop out, but then just re-entering the trade right there with a little bit more of a heavier position size. It's roughly the same thing. If you lose, and yeah, you lose a little bit more, the key is just to know what the statistics are. How likely is it for price to continue ripping up and up and up and up and up, and you're wrong like 5 times in a row? For me, under normal conditions, without being constrained by margin and leverage requirements, my previous win rate, like for the first 6 weeks that I ran the Nick's Trades Group, it was like 90%. It was some crazy shit like that. Like 90% of outcomes would result in either a break even or some degree of profit. So when I'm able to manage it normally, those are what the stats are. In this case, it's not based on like one standard lot for every 20 pips. It's just based on like from here to here, if I use this lot size, how much dollar amount risk is that? So I'll figure out I'm comfortable risking 10K. Let's say the lot size comes out to be like 12.5 lots. I'll use that lot size. Then if it goes up there, if the plan is to add to it when it goes into that invalidation, then I know that'll be at $10,000 loss at that time. Then I'll add to it. Now the trade goes from 10,000 to $30,000 of risk. That's how I do it for a DCA risk structure.
Yeah. Okay. My question was just because I saw your trade, you just split the trade. For example, the last trade of Euro Aussie, I believe, you were taking 4 lots a time, 4 lots, right? Then you stop, it stops you out. Then you start another cycle again.
Yeah, the reason for this is just because, so there's two reasons for this. The first thing is that I don't use a position size calculator just because it's easier to just use my terminal. Because
Yeah.
on TradingView, right, whenever you're not TradingView, on MetaTrader 5, like I'm using right now, I can just tap the entry and it'll show like what the dollar amount of risk is, right? So I can tap it, it'll show negative 4,000 or whatever it is. So then I know, okay, if that was 2 lots and that was negative $4,000 and I want to risk, like 20,000, then I will need to have 5 times the position size. So then I will add, another like however much more volume until it gets to the point. Now, normally you'll just see me have 2 positions at once. You'll see me have a 1 standard lot, and then I'll determine, okay, this 1 standard lot, if it goes there, that'll be $1,000 loss. If I want to risk 10,000, I need to have 10 times the position size. So that means a total of 10 lots. So you'll see me have a sell for 1 lot and then a second sell for like 9 lots with the total risking 10K. The reason I have multiple positions here is because this is funny. It comes back to the leverage thing. Is I don't know how much margin that's going to chew up. I'll only know after I
Yeah.
enter. So it's kind of like me, like if you have a gun and someone's in the next room, you're not gonna run straight in there. You're probably gonna like
Yeah.
look at the doorway, going very, very slowly.
Okay.
So that's why
Yeah.
you see all those positions, is because I'm like adding, and then I'm like looking, okay, is it too much margin? Nope, I can add another one. So then I add, I'm like, is it too much margin? Nope, okay, can add another one. All the way to where I got to the point where I'm like, okay, this is 20K risk. If I dip below 40K margin, it margin calls me most of the time. So at that point, it was like 50K margin, so I couldn't do anymore. That's why you're seeing all the fucking positions. It has nothing to do with the actual risk structure. So sorry if that confused.
Okay. Yeah, definitely. So it is basically based on testing your broker parameters or margin requirements rather than a risk structure like 20 or 30 pips up, and then I will take my second entry, right?
That's right. For now, this is what it's come to. The professional Nick FX guru trader is having to like beg his broker to give him margin so he can enter the trades.
Mhm. Okay. Thank you, Nick. Thank you.
Good question, man. Thanks for that. I'll have to learn Arabic so that way I can read y'all's names whenever, if y'all are like Arab, I'll have to be able to read it. So I'm gonna go learn the entire language of Arabic just for you guys. Call it customer service. Okay, I don't see any more questions in the chat or here in the Zoom call, so I'm just gonna hang out here for another like 30 seconds. If we get any questions, I'll answer them, and if not. And we've got Vicky. Spoke too soon. Vicky says, when you plan your stop loss and take profit, do you take into consideration how many pips the currency pair moves in average just to make sure you don't have to hold your position too long? I guess not. So I guess the answer is no. Like what I'm interested in is the outcome occurring. If it takes like a week versus 3 weeks, I don't care. Now, if I'm looking at like the monthly chart and I'm like, okay, the average move, it's for, 1,500 pips from here to here, takes like 6 months. I'm probably not going to enter that because I would like to not hold a trade for 6 months. I would prefer it to be like, ideally, I'd prefer to enter and it just goes immediately to the target, but taking into account trading reality, it's generally, if you're swing trading, going to be like a couple days to like a week or two, in some cases 3 or 4 weeks. What I'm interested in is being right about the outcome a high percentage of the time, and then just letting that play out. I'm okay if some trades take 3 days and I make like 50 grand in 3 days, or if another trade takes like, a month, but I still make 50 grand on it. I'm interested in the outcomes and the statistics playing out. I'm not as interested in the duration of the trade, provided that it's not something extreme. Like if you were telling me like, this shit's probably going to take 6 months to come to fruition, Nick, and then you're not even guaranteed to win it. It could be 6 months of paying swap fees and all that bullshit, and then it could lose. Like, yeah, we should not dismiss that. We should still take that into consideration. But in general, if it's the difference between like 1 day to like a month, I don't worry too much about that, just because I'd rather have the stats play out instead of worrying about the trade duration. Does that make sense? Let me know. I'll wait. Oh yeah, you can do that. I'll mute it. Bonnie was making a smoothie with the blender, so I've saved you guys from the very loud noise. Vicky, I'm glad it helps. Good stuff. I'll stay here on for another second and we'll see if you guys have any other questions. And then if not, then we will wrap it up. This was an amazing live session today. Had a lot of good questions. This was my dream of like Mission FX. Like whenever I reopened up close friends for new clients yesterday, my dream is that people would come, they would have engaging conversations and ask questions, and so it works. It's good. I'm happy you guys are here.
Hey, Nick.
So
This is David Barry, brand new to the group. How are you?
great, man. What's up?
I just had a question. In all your experience, did you ever get into lower time frames, more, I guess, like scalping type of things, or did you ever find any success with that? I know you don't do it much now. You've had trades go immediately into profit, but you're never looking at those low time frames.
Have I had success trading lower time frames? The answer is no in isolation. And if I did have success in it, it was like more of a pain in the ass, and it was like more patchy compared to trading what I would call, quote, higher time frames, which is like 1 hour, 4 hour daily. You could even say the 1 hour is kind of a lower time frame given the context of swing trading. Daily and 4 hour, for I don't know why. I seem to get better results, and it takes like 90% less work. Like it takes only 10% of the work. As for like the frequency of the trades, the frequency of like their duration happening and ending, and then you get into another one, and then the volatility is spiking up and invalidating stuff. It just doesn't seem to move as, quote, steady state as like the higher time frames, which for me, I don't know why, it just seems like they're more reliable. So while I have brief periods of success trading lower time frames, that success was either short-lived and then it would come back to break even during a losing streak, and then I would make profit, and then a losing streak, and it would just roughly come out break even. Or it would be profitable, but not as profitable and more of a pain in the ass as compared to trading higher time frames. Even when I was testing those things out, because I've experimented a lot over the past 8 years to try to see if there's anything I'm leaving on the table, I noticed that it would just kind of evolve back into my swing trading, which I'd be like, I'm going to trade the 1 minute chart because if the setup is the same as in the higher time frame, I'll trade trends on the 1 minute or overextended markets on the 1 minute. But then I'm like, okay, that stopped out. If I go to the 5 minute, I can get a little bit more context there, and the volatility isn't as crazy. So I'll just use the 5 minute. But then I'm like, well, on the 15 minute, it's even better. And that's the big picture. So that's where I'll use the 15 minute. But then it evolves all the way back up to the 4 hour and daily. And then I'm like, okay, well, what's the point of like the 1 minute? And then I just like start swing trading again. And then I just like laugh.
All right. So if we're back testing, if I'm, like I said, I'm new, we want to stay with the 1 hour, 4 hour dailies and look at trades like that more. So learning how charts work and how price action works, than getting into these 15-minute, 5-minute.
Given my experience and also what I've seen teaching people for the past 6 years, I think that's probably a better idea, not financial advice, to just use the 1 hour, 4 hour and daily. That's what I personally do. Every now and then I'll look at the 15 and the 5, but it doesn't really add a lot of value to anything that I'm actually doing. The majority of clients that I've had that I see get profitable on lower time frames, they're generally trading faster moving assets, meaning assets that they move more than like 0.25% a day, which is like FX assets move like anywhere from 0.25% to maybe 1% per day on very volatile days. If someone's trading like the S&P 500 or the NASDAQ or the FTSE, it's so they're trading like commodities or futures or indices, I've seen them use lower time frames because there's a lot more texture and granularity and detail and subtleties and nuances on those lower time frames. It just moves way faster. It's way more liquid as compared to FX, which is very liquid, but it just doesn't, like, the granularity and the texture in the lower time frames is not as high as compared to the higher time frames. So if you want to trade like something like futures and like stocks, like fucking penny stocks, where every fucking candle on the 1 minute matters because everyone's looking at it at that time during the session open, that in that context it will work fine. For what I'm doing in FX, at best it's just a bunch of extra work for no reason, and at worst it just fucks my profitability. So that's why I don't do it. So if you're going to be back testing, I don't think it's a bad idea to use 1 hour, 4 hour, and daily. I would probably lean towards like daily and 4 hour. But yeah, you do whatever you want. That's just what works for me. So yeah.
Okay, thank you.
Yeah, man.
Oh, one more question. Back testing. Is there a best pair to start with? I know you trade all of them, but to learn a chart, to be comfortable and start learning, is there one particular pair you think is safer or better to learn to start?
The answer is no. I don't think there's any specific pair that's more magical than the others or that has a better win rate or this and that. It's all subjective to begin with. All that will matter is you getting experience. So a way that I like to do this is I go to what's called random.org, and then you just pull up your watch list of currency pairs. You can take a screenshot of my watch list if you like. These are the pairs that I trade. The only thing that's not a currency pair is Bitcoin right here on the bottom. But aside from that, these are all the FX pairs that I trade. And let's say, for example, this is like 1, 2, 3, 4, 5, 6, 7, 8. Let's just say there's like, 20 pairs here. I'll go to random.org. I'll do the random number generator. It's just random.org. You get here on the number from 1 to 20. And then it comes up with 14. Then I'll go down the list to whatever number 14 is. I've just picked that one randomly. And then I'll click a replay and then just random bar. And this takes me back to whatever this October of 2017. Sweet. Back when I was just a kid. This was a year after I started trading. So it takes you back here and then you can just back test that way. This way it kind of randomizes it all and it gives you experience seeing everything. There ought to be something to say for different pairs move differently. For example, Euro GBP doesn't move the same in terms of pips as other pairs. Like this huge fucking move right here, that was 180 pips. Cool. It sounds like a lot until you go to a pair like GBP JPY, whereas like this impulse here was like 1,500. Like, so it just different pairs move different in terms of pips. But I think just randomly going to different pairs, whether you use a random number generator or you just click random pairs and just go test it, just go out and test it to get some experience. And I'll do all of this with the caveat of saying, I don't believe that back testing should represent any more than maybe 10% to 20% max of how you gather experience. I believe the majority of it, 80 to 90%, should come from live market data that you're trading on a demo account to get experience. There is no shortcut. It'll probably be a minimum of 1 to 2 years before you get profitable. And that is if you even get profitable to begin with, because we are in an industry where unfortunately 90% of people will lose money. So over the course of 1 to 2 years, that can kind of start to get to the point where you can start kind of catching all the nuances and all the dynamics. But back testing, it's very difficult to simulate real market environments in there, because on the 4 hour and daily chart, a couple candles could be like a week or two of data. And so it would have been a trade you held for a week or two. And that would, like in real life, would you have actually done that? Would you have had the margin? Would the swap fees have been killing you? Would you have closed partials? Would you have looked at the price action, decided to do something different? It's very difficult to track those on to like be 100% aligned. So I believe it's good for using backtesting as like a proof of concept, as like a model for what you could test forward testing on a demo account in real time. Or if you make YouTube videos about trading like me, you can use the TradingView replay tool to illustrate your concepts. You just have to accept there's going to be a bunch of fucking people in the comments criticizing every goddamn thing and saying, this would never work, blah, 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 blah. And then you just have to deal with that. But aside from that, back testing on the replay tool is like good in general for just a proof of concept and modeling something. Then I believe you ought to move to live market environment on a demo account and just trade. It's called forward testing. Just do the real market environment on a demo account, get the experience that way. I think that's where like 80% or more of where your experience should come from. I know this was a long-winded answer. I just wanted to make sure that you being new have what I believe is kind of the best perspective on how to approach it. That makes sense?
Yeah, I appreciate it. Thank you.
Yeah. Lauren, you're up next, man.
Yes. Do you really trade on the USD MXN pair, or was that just a one-time thing?
I do trade on the USD MXN pair, yeah. I called a trade a couple of months ago, and Nick's trades on the USD MXN pair. I know you're not in there, but I
No, I did see that trade also. That was just a one-time trade because, the spreads on there are actually crazy. I did it once, but it didn't work out just because my spreads were so wide on that pair. I
Yeah.
don't know, is that
What
something that you're interested in?
With my broker, it was sort of the same situation. I ran out of margin, so I was right about it, but it didn't play. I couldn't allow the trading outcome to come to fruition because of like the very extreme levels of margin. And also the spreads for some reason didn't seem to be that big of a deal, but I have noticed before that certain exotics like MXN currencies, GBP MXN, Euro MXN, USD MXN, yeah, those spreads can get really wide and the swap fees can be bigger depending on whether or not you're long or short. And also the session changeover can make it just go real slow. And you'll see like sketchy as fuck price action, like the kind of price action that you see in like the back alley in downtown Fort Worth at nighttime, like super sketchy price action, man. The kind of price action that's trying to sell you drugs and shit on your trading account. So you want to avoid that shit. Yes. If you've noticed that the spreads seem to be high, session changeover and rollover causes spreads to go really high, and you don't see it as a viable pair for trading, then just trade the majors and minors. Don't worry about the exotics.
Okay. Do you trade any other MXN pairs or just with the US dollar?
I don't. I found the USD one to be the most liquid. There's like so here, this is USD MXN. To me, this looks fine. Like, right, like this was one of the setups that I had called.
Yeah.
I didn't hold that long, right? I think I was wrong on the first entry. I had to re-enter with a different position size because it chewed up too much margin. Then on the second one, I think it came in a profit. Whatever happened, don't take my word for it right now. It's all documented in the Knicks Trades group for those of you who are hearing this or those of you who are watching this on YouTube. Whatever actually happened is in the Knicks Trades group. Just go and look at that. All that history is tracked. But I believe I like shorted from here or somewhere in here, then it came down into some profit and I closed, and then it would have ended up going into a lot more profit. But that was the first one. This was another good opportunity, but I didn't have the margin to be able to do it, nor did I see the opportunity occurring because I didn't have an alert there. This one compared to Euro MXN, let's just have a look. Let's see. Same shit. So it'd be kind of foolish to trade both at the same time. And GBP MXN, the same shit. So it's almost like, since they're all like, you don't want to be shorting all three of them at the same time because it's essentially like taking the same trade, but with 3 times the position size. For some reason, I just use USD MXN. Maybe it's because it's the highest leverage for this MXN currency on my broker, or maybe it's for some other fucking reason. Or, maybe, dude, I'm just biased because it's the US dollar and I want to flex my heritage here in the United States and really have my country's, what's this called? I forgot what this term is called for being like patriotic. Is that what it is? I want to be patriotic. That's why I trade USD MXN. That's my final answer.
Okay. I have one more question. Like for example, with MXN trades, when you have multiple of the same pairs, like for example, the US dollar, you generally look at which is the bigger move of the ones who have set up correctly.
Yes.
Yeah. Okay. Thank you very much.
Absolutely, man. Yeah. It's funny. You just became a client yesterday, but you followed so much of my free shit so diligently. Like you're already, it's so funny. Like you're like, you do this, you do this, you do this. And I'm like, yeah, wow, that's crazy. You've picked up so much from my free content. That's crazy.
Yeah, I mean, you're a good teacher, so I learn a lot.
Well, that's good, man. That makes me feel nice and special right here in the morning. And I think this is a great spot to end the session. So I'm just going to go ahead and end it right here. Y'all, I had a lot of fun. We will do another live session at some point later this week, whenever I feel like it and whenever I have the time to do so. So I might see you guys tomorrow. Maybe it's Wednesday, maybe it's Thursday, but I will see you guys. For all of you guys who participated and asked questions in the chat and on the session, thank you. Really appreciate you guys. It was a lot of fun. Recording of this will be on YouTube soon.
Hi, Nick. Thank you very much. Have a great day.
Fellow German friend, I will see you, Lars. You have a good one yourself. You have fun playing that double bass, man. Have fun. Enjoy yourself.
Yes, thank you. See you soon.
See you, man.
See you guys. Peace.